स्टार्ट करिए।
हाँ कर दीजिए रिकॉर्डिंग। Good evening and I welcome you all the participants to this wonderful series on Ind AS. Today being the last day, I'm sure in all the previous days you might have learnt a lot, and today again there will be a good learning opportunity. And now I request Mishaji to please play the logo for our of the institute.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
So our motto says a lot about our profession. Now I request Chintan, the chairman of the committee, to please give some brief about the event.
My council colleague Vikas Jain, council colleague and dear friend Vikas Jain. The faculty of the session, C. Venkata Subramani, is also a very good dear friend to me. Obviously, he's a very senior person, but we share a very old rep of more than 10 years, where we come across on Ind AS, IFRS related training, and then still we are together. And we hope to do many things together over the period. All participants, good evening, all of you. I think my objective of coming and teaching and touching with each one of you was to again talk about being a last day today. I would like to also get the feedback from all of you that how was your session. In case if you have any suggestions, any feedback about faculty or a topic to be dealt with it, please be in touch with me, because we are trying our best to ensure that we are able to give best of a course. Ind AS is something which we all are aware that this cannot be ignored. For all large size companies, Ind AS is compulsory in India. It is like IFRS. So with this objective in mind, we have designed 8 days, every day 3 hours, 24 hours course, where we are trying to touch upon the most important practical aspects. However, still if you have suggestions, because this kind of course we organize every year. So in case any feedback, any suggestions, please be in touch with me. I'm going to share my email ID to you. It is cnpatel@gmail.com. You can also be in touch with me phone. However, my humble request to each one of you that whenever you give comment, please give a constructive comment in such a fashion that we can really learn from that and ensure that next time it will be much better than current one. Today's topic is again a very critical, very important topic. If I just look at the first complex and the most relevant topic across 8 days is the today's topic, because number one, financial instrument. If you talk about any company, the Ind AS implementation or Ind AS convergence is incomplete without touching financial instruments. So 3 hours is actually a very short span of time. However, we wanted to touch upon the very important principles, which are the core concepts of financial instrument under Ind AS that is being be taught, so that we can apply in our practice. So I'm sure that the Venkata has a very large experience in handling financial instruments with complex cases of banking and other things. So from his experience, we are able to really learn many things from him. So thank you so much, Venkata, for accepting my invitation, coming here. And once again, thank you everyone. This being a last day in the session of Ind AS refresher course. Let's be in touch. any questions, any suggestions, any feedback. As a council member, we all are available with you, and we are trying our best to provide you best of best refresher course in future. So with this brief words, I request Vikas Jain to take it ahead.
Thank you, Chintan. I'm very privileged to introduce our today's learned faculty, Sri R. Venkata Subramani ji. He is the founder of RVS Bell Analytics, a cloud-based software platform providing analytical solutions for accounting as per Ind AS. He has graduated from Madras University. He is a chartered accountant with more than 3 decades of experience and who began his career with a professional accounting firm in Chennai way back in 1983. Sir is engaged in IFRS Ind AS advisory for several clients across the globe, specializing in accounting for financial instruments. He is currently handling several NBFCs in the valuation of the expected credit loss, calculation of loan portfolio, and other financial instruments. He has also previously worked with Calypso Technology, specializing in hedge accounting as per IFRS 9. He is also a leading provider of cross-asset technology solutions for financial markets. Calypso is being used by several banks, financial institutions across the globe. During this tenure, Venkat's team was responsible for implementing hedge accounting for several banks situated in Sweden, Australia, New Zealand, and London. Truly a global exposure, I would say. Prior to this, he was heading the head of business management and operation control at Northern Trust, Bangalore. Northern Trust Corporation is a Chicago-based bank. Prior to joining this Northern Trust, he was COO of managing team of core finance and accounts profession in US-based hedge fund administration firm, serving several global clients. He also holds an IFRS from ACCA UK. He was a rank holder in both the CA and ICWI exams. He is having a vast teaching experience as a faculty at ICAI of India for Ind AS certificate course for the last 6 years. He has been conducting several courses on financial instruments for participants from regulators, several banks, and corporate entities. Besides this, he has authored many books that includes Accounting for Investments, Volume 1, Volume 2, then Financial Instruments as per Ind AS, published by Walter Kluwer, CCH, and 2 other books on Kindle platform. With these brief introduction, I present before you our today's learned faculty. Sir, I welcome you on behalf of all the participants and on behalf of WRC. The dice is, this mic is yours, sir. Thank you.
Thank you, sir, and thanks, Chintan Patel, for your kind introduction, and for giving me this opportunity to participate once again at WIRC. WIRC is an excellent platform, where a lot of erudite chartered accountants participate. Usually, it is always an interactive session, and every session I actually learn more from the participants. That is how my past experience has been. So we will straight away go into the session today. See, I just want to make one small announcement with the permission of the chair. Today we are going to see about financial instruments that covers all the accounting standards relating to that, especially Ind AS 32 and also Ind AS 109. Now, this we are trying to cover in about 3 hours time. The same syllabus in depth is going to be covered by ICAI, Delhi, in 2 modules, Module 1 and Module 2, each module spanning over a period of 15 hours. That is, there will be 5 sessions in each module. So 5 into 2, 10 classes in all, that's Saturdays and Sundays, 3 hours each, 10 to 1. And so totally about 30 hours. The same topic will be covered in about 30 hours. It is an in-depth course, and I'm happy to share the link. The reason why I'm making this announcement is that it's going to start from this Saturday onwards. That is starting from 7th of May onwards. So this is a great opportunity, because otherwise you will miss this opportunity to spend about 30 hours on this complicated, complex topic. Okay, so I will share the link with you during the course of the session, and you please ensure that most of you participate in that. It's definitely a worthwhile program. Okay, now let me share my screen now. Okay, so we have sorry. Okay. Yeah.
The slide show kariye. Okay.
Yeah, you are able to see the screen now. You are able to hear me properly. All good to go.
Yes, sir. Yes.
Okay. Okay. So I'm not able to see. Okay, please make it as interactive as possible. You know, there are about 99 participants as of now. Let's make it interactive. So whenever you have doubts, please feel free to stop me, raise your hand, or ask questions. We will try to make it as interactive as possible. Okay, now see, the first thing, you know, now what I normally do is to give an orientation about some of the financial instrument, the nuances of the financial instruments itself, before we dive deep into the accounting standard, because that will give an excellent idea about the concepts that we're going to discuss. Otherwise, it will be a little difficult. So pardon me if I'm going to spend some time on this one, maybe about 30 minutes or so we'll try to spend on understanding the nuances of some of the instruments. Okay. Now, see at the outset, I just want to tell you that, you know, we are going to see the three accounting. Actually, the accounting standards are basically three accounting standards, which are you know, IAS, you know, Ind AS 32. You have Ind AS 109, and also Ind AS 107, which is predominantly a disclosure standard. So that standard we will not cover because it's only purely a checklist kind of a stuff. So earlier we had as per IGAP, AS 30, 31, 32. Unfortunately, this did not see the light of the day. You know, it was supposed to become mandatory from 1st of April 2011. But on 31st of March 2011, it was withdrawn. All the three standards were withdrawn, and it never saw the light of the day. See, the reason why I want to give this background is that because, you know, these three standards, namely 30, 31, and 32, were the exact replica of IAS 39, IAS 32, and IFRS 7 as it stood when it was in the year 2008 and 2009. Subsequently, we had several changes. In fact, IAS 39 itself got replaced by IFRS 9 during the course of about 4 years or 4 to 5 years, so to say, or rather 4 specific installments of changes starting from 2009 onwards. So 2009, we had the first chunk of changes to IAS 39, which morphed into IFRS 9. So 2009 was about classification and measurement. 2010, the second installment of the same classification and measurement were announced. 2013 came some major changes to the hedge accounting principles, and in 2014 came the last installment, which is about impairment or the expected credit loss. Now, at that point of time, what happened was it was announced on 24th of July 2014. 24th of July 2014 was the IFRS 9 was finally announced. At that point of time, both the standard setting bodies sitting on both sides of the Atlantic Ocean, namely the IASB and FASB, IASB and FASB, who are respectively in charge of IFRS and US GAAP, they agreed to disagree on the provisions of impairment. So this only tells you that the impairment provisions, as far as the expected credit loss provisions are concerned, the requirements of US GAAP and IFRS are a little different. There are subtle differences. I know we're not going to go deep into that, but I thought, you know, you can just have a bird's eye view of this genesis of this standard so that you understand how the whole thing transformed. Now, the reference to IAS 39 is also there because of two reasons. One is, you know, you would have heard frequently that IFRS is the principle-based standard and US GAAP is a rule-based standard. You would have heard it umpteen number of times. But then even IAS 39 was to some extent considered to be rule based. So that is what they wanted to remove, and IFRS 9 has really made the entire accounting standard completely principle based. So today IFRS 9, you can truly call it as principle based, and some of the rigid requirements of specified in IAS 39 are no longer there. Fortunately for us in India, we do not have the trouble of unlearning Ind AS 39. I'm sorry, unlearning IAS 39 and then learning IFRS 9, or in other words, we directly are now learning Ind AS 109, which is an exact replica of IFRS 9. So to that extent, we can say that we are pretty lucky here. So there is no need to unlearn. Now, I just want to give an overview of some of the concepts or some of the principles, some of the nuances of the financial instruments. I'm going to start with hedging. Now, the reason why I want to do this is also because hedge accounting also we will try to cover as much as we can. Okay. I have the entire PowerPoint presentation which will be shared to you at the end of the session. So, but at a conceptual level, if you're not able to go through the entire PowerPoint, it's okay. But I want to give at a conceptual level what is hedge accounting and how it is achieved. So in that concept, you can please listen to this one. So first, let us try to understand what is meant by hedging. Now, as far as hedging is concerned, it is a mechanism to minimize the loss or to protect unrealized profits. Okay. So the point here is that you minimize the loss and to minimize the loss and to protect unrealized profits. Okay. The objective is not to maximize the profit. Okay. Maximizing the profit is not an objective. That should be very clearly understood. And this hedging is basically a risk management tool. Okay. Now, in order to have hedging, there has got to be two instruments. One instrument is called as the underlying instrument, and the other instrument is called the derivative instrument. Normally, this derivative is taken on the underlying instrument. Now, the first one is called the hedged item, and the second instrument or the derivative is called as the hedging instrument. Now, this hedged item and the hedging instrument. So there has to be two instruments. Now, normally the fair value changes of one instrument will compensate the fair value changes of the other instruments. In other words, both these instruments, the fair value of both these instruments will move in opposite directions. So if there is an increase in the fair value of the hedged item, there has to be a decrease in the fair value of the hedging instrument. Now, this has become more or less a mandatory requirement for hedge accounting to sustain. Okay, so both these instruments should move in the opposite direction. Now, to put it differently, if you want to have hedging, there has got to be two instruments. There has got to be two instruments. Now, the underlying instrument, there is an underlying instrument and there is a derivative instrument. Now, the derivative instrument is taken in the opposite direction of the underlying instrument. What do I mean by that? It means that if you have a long position, or if you say, for example, taking the case of an equity share, if you have a bought position in the equity share, then you should have a sort of a sold position in the derivative segment. Now, this derivative segment consists of two types, which could be futures and options. Now, let us take the case of options here. So if you were to have options, then you should have a sold position. Sold position means effectively, it means that you should have a bought put option. So if you have a put option, it means that you have acquired a right to sell. Buying a put option means you have acquired a right to sell, which means it is equivalent to that of a sold position, or as an opposite position than that of the underlying. So let me reiterate. If for hedging, there has to be two instruments. One instrument is called as the underlying instrument, the other instrument is usually a derivative instrument, and the direction of the derivative instrument should be opposite to that of the underlying instrument. Then it is called as hedging. Any doubts on this one? Do you have any doubts? Please stop me. Now if you have this as the background, I just want to tell you about one more thing. I don't know how many of you do not know about options. Do you want me to tell you basically about the call option and put option, or are you all comfortable in knowing what is meant by a call option and a put option? Can anyone? I don't know how you communicate with me. So is it by the in the questions or in the chat box, or what? You can type out in the chat box. Is that how you do? Can someone type something in the chat box so that I know that I'm able to see what you're typing? No, I don't see anything. Okay. Okay. I don't see anything. Are you? Am I audible? Are you able to hear me well? So normally it's not possible to communicate, is it, with this, or do you communicate? Okay. I don't see any response whatsoever. Vaibhav or any organizer, anybody is there who can intervene and tell me? Okay, I don't see any answer. Okay, now let me give an overview. As if it is a call option, you have a right to acquire, you have a right to buy. Okay, but there is no obligation to buy. That is what is called as a call option. If it is a put option, if you are a buyer, if you are a buyer of a put option, you have the right to acquire the underlying instrument, underlying asset at a specified strike price, but there is no obligation that you should sell. If it is a put option, you have the right to sell, but there is no obligation to sell. If it is a call option, you have a right to buy, but there is no obligation to buy. So this means that whenever you are having a bought position, it means that you always have a right and you don't have an obligation. So if it is a hedging instrument, the hedging instrument should be a bought position. It cannot be a sold position, because if you are selling an option, it means that you are increasing your risk. So it should always be a bought position. Okay. Now let us see. Okay. Now let us see what is meant by open interest. Okay. In the derivative segment, the options and futures contract get settled on the settlement date. So till the date on which it is settled, the total number of outstanding contracts is known as open interest. Open interest means the total number of outstanding contracts that are yet to be settled on the settlement date. That is what is called as open interest. So if you are trading in the shares of, say, Tata Steel, and if the total underlying number of shares in Tata Steel is, say, 100 crore shares, It means that the total number of open interest, which is the outstanding contract, can be infinity, because the buyer and the seller come together and form the contract in the case of a derivative segment. So theoretically, the total number of contracts that can remain open, that is unsettled till the expiry date, is infinity. Now that is, keep that in the background. Okay. Now I'm going to tell you about what is meant by the what is meant by speculation. Okay. Let us see what is meant by speculation. Speculation, I have already told you what is meant by hedging. Hedging is the process by which you have an underlying and you take a position in the derivative segment which is opposite to that of the underlying instrument. That is what is called as hedging. So in the case of speculation, you have a position in the derivative segment, but you do not have any underlying, then it becomes a case of speculation. So the position what you take in the derivative segment can be any direction. It can be any direction because you don't have any underlying itself. So that is what is called as speculation. Now, what is gambling? Now, gambling is where the total open interest exceeds the underlying. You have a position in the derivative segments, but the total open interest exceeds the underlying. Like for example, take the case of Tata Steel. I told you that the total number of underlying contracts, underlying shares is say 100 crore shares, and I also told you theoretically that the open interest can be infinity. So let us assume the open interest is say 250 crore shares. So that means to the extent of the difference between the open interest and the underlying one, which is 150 crore shares, is what is called as gambling. Okay, but this gambling is not possible in the exchange traded environment because there are restrictions on the open interest. So open interest can never exceed the underlying. That is the requirement for the exchange traded securities. So in other words, if you are taking a position in the derivative segment, that is either it is a futures or an options in the stock market, then you are at best speculating and you are not gambling. Okay, I think that is the basic introduction that I wanted to give you. But you know, in the absence of being not able to get your feedback, so it becomes difficult because you know I actually ask certain questions, and based on the questions we will actually be proceeding. But I think there is a little bit of challenge there, so which is fine. Okay, now let us move on. So now what the essence of what you have learned now are two things. One is as far as hedging is concerned, you have to have two instruments, one underlying instrument and one derivative instrument. Now the derivative instrument, if it is an option based instrument, it has got to be a bought contract, because if it is a sold contract, you are increasing your risk and you are not minimizing the risk. So the contract has got to be a bought contract. Okay, so that's the only thing I wanted to communicate here. Okay, and also you know there is a chart here, I think, which we can go through this one. So okay, okay, if you are able to see this one now, see there is a basic difference between futures and options. Okay, both are belonging to the derivative segment, futures and options. Both have notional amounts. Both have an underlying instrument, which is equity shares. Then both have an expiry date. The investment amount is a small amount in both the cases. The case of risk reward In the case of futures, it is symmetric. In the case of options, it is asymmetric. So this is the key differentiator between futures and options. So if is it a hedging instrument? Normally, futures is not regarded as a hedging instrument normally, but there are exceptions to this rule. But if it is a bought option, then it can be used as a hedging instrument. If it is a sold instrument, it is not. It cannot be used as a hedging instrument. Now, maximum profit, if it is a bought option, in the case of call option, it is unlimited profit. In the case of put option, the maximum profit is the strike price only. If the maximum loss, it's a directional call, so the risk reward is symmetric. In this case, in the case of futures, in the case of options, if it is a bought option, then the maximum loss is the premium that you pay. If it is a sold option, the maximum profit is limited to the premium that you have received. If it is a sold option, then in the case of call option, virtually the loss is unlimited. You can get unlimited loss here. And if it is a put option, the maximum loss is restricted to the strike price only. Okay, this gives you the characteristics of the futures and option contract. It is useful to understand this one when we go into the hedge accounting. Okay. Now there is one more point I think I want to talk about, you know, before we get on with the accounting standard. Okay, which is let me open the okay. Now we can basically see this itself. Okay. Okay, now how many of you are familiar with interstate swaps? Okay, because understanding the interstate swap is imperative for us to learn about hedge accounting. So the interstate swap is a mechanism by which the interest is exchanged between two parties. The interest is calculated on the notional amount. Notional is not exchanged. Interest is exchanged. Only the interest is exchanged. Now, the interest is calculated as a percentage. Interest is calculated on the notional based on certain benchmark. It could be a fixed or it could be based on a benchmark like say a LIBOR or MIBOR or whatever. Okay. Now there are two legs to the interstate swaps. One is called as the pay leg, the other one is called as the receive leg. So the interest gets swapped. The very purpose behind taking an interstate swap is to convert a fixed rate exposure into a floating rate exposure. The purpose behind interstate swap is to convert a fixed rate exposure to a floating rate exposure. Okay, that is the purpose. Okay, now maybe let us look at this one. So you are able to see the Excel sheet here. Okay. Now let us assume that the notional is say 100 crores. 100 crores is the notional. Then you have a receive leg. You also have a pay leg. Okay. Now let us assume that the pay leg is say 8%, and your receive leg is based on LIBOR, or let us say MIBOR plus 2%. MIBOR plus 2%. And this, let us say this is year 1, 2, 3, 4, 5, etc. So on the date of starting the swap, the benchmark, the MIBOR is say 6%. So you will be receiving 8%, 6 plus 2, 8%. You will receive 8%. You will also be paying 8%. That's how the interest starts, because on the date on which the swap starts, the fair value has got to be 0. So that is how it starts. then let us assume that it becomes 7% at the end of the first year. So that means during this year, interest will be exchanged at the rate of 9%. So you will receive 9%. You will receive 9%, but you will have to pay a fixed rate of say 8% only. Let us assume in the third year it becomes actually 8%. Okay, so you will receive 10% and you will continue to pay 8%. This is how this interest will be exchanged. So the interest is exchanged on what? The interest is exchanged on the notional. The notional never ever undergoes a change. The notional is not notional is not exchanged, because there is no point in exchanging notional, because the base is going to be the same. But the interest is calculated on the notional amount. So in this case, what happens? You will actually be paying and receiving based on these rates. Okay. Now, the corollary of this is that there is always what is called as the fair value of the swap. Now, on day one, the fair value is 0, because on day one, whatever you receive and whatever you pay is going to be the same. But at the end of the first year, you would have already started receiving at the rate of 9%, and you will pay only at a rate of 8%. So which means the fair value of this will be a positive fair value. So it will be a positive fair value. So let us assume that the fair value is say 4 crores. The fair value is say 4 crores. So this 4 crores will be recognized as an asset, and it will also be recognized as an income, because this is a positive fair value. And let us assume in the next year, the positive, it will be a positive fair value, because what you receive is more than what you pay. So obviously the fair value of this swap will be positive. And let us assume that you have additional 3 crores. Additional 3 crores is your profit. So this will also be, so in the balance sheet, it will be recognized at say 7 crores, 4 plus 3, 7 crores. Now this is just for you to understand the mechanism of an interstate swap. Okay. Now let me reiterate. The purpose of the interstate swap is to convert a fixed rate. Now here what happens? This is a fixed rate. This fixed rate gets converted into a floating rate, and that is the whole purpose of this interstate swap. Okay. So the inadvertent consequence of this is that your profit and loss account gets fluctuations, unnecessarily it gets fluctuations in the profit and loss account will get fluctuations because of the fair value of the swap being recorded in the balance sheet as well as in the P&L. Okay, now let us move on. So if you understand this one, all these things are going to be helpful for us to understand the accounting standard itself. Okay, now I think the essence of this one is enough over. Now let us get on to the next one, which is we will get into the standards right away. Okay, now let us start with Ind AS 32. Now this Ind AS 32 is now the entire financial instruments gamut, as I told you, consists of mainly 3 instruments, the 3 accounting standards, which is Ind AS 32, Ind AS 109, and Ind AS 107. So Ind AS 32 talks about the classification as liability and equity, offsetting financial asset and financial liability. Ind AS 109, 3 key things. One is the recognition, derecognition, classification of assets, measurement of financial assets and liabilities. It also talks about other 2 things, which is hedge accounting and also expected credit loss. Okay, so these are the key things in Ind AS 109. 107 is merely a disclosure standard. Now let us look at Ind AS 32. There are 3 key items. These 3 items are part of financial instruments. That is the subject matter of our discussion today, which is financial assets, financial liabilities, and equity. So whenever you have an asset, whenever you have a financial asset, we need to examine whether that financial instrument is either a financial asset or a financial liability or an equity. So there are certain methods by which you can find that out. First thing is, let us get into the definition of what is meant by a financial asset. Now, this financial asset consists of cash. Now, this cash is specifically spelled out. Cash is specifically spelled out as a part of a financial asset. Cash is a financial asset. Okay. Then equity instrument of another entity. Equity instrument of another entity is also a financial asset. So these two things are specifically listed. There is nothing, no condition, nothing. Now, the next one comes a contractual right. Very, very important that it has got to be on account of a contract. So it can't be without a contract. There has to be a contract. And based on the contract, you have a right to receive cash or other financial asset. So you would have noticed one anomaly here. We are discussing about the definition of a financial asset. So while we are discussing about the definition of a financial asset, the term financial asset cannot come here because it becomes a circular reference. As per Excel, this is known as a circular reference, but this is really not so, because ultimately what is expected is that this financial asset has got to be transformed into either cash or it has got to be transformed into equity instrument of another entity, which means that the financial asset should ultimately be realized or transformed into one of these two items. So the contractual right, you can say for the sake of easiness, for the sake of easy understanding, you can say that it is a contractual right to receive cash, because other financial asset also has to transform into cash. So you can simply say it is a contractual right to receive cash from another entity. Then the second one is a contractual right. This continues because this comes under this. It is a contractual right. It is a contractual right. It is a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. So this is what I was discussing initially in the first half an hour of the session. Favorable to the entity means this has got to be a purchased call option or a purchased put option, because if it is a purchased call option, the value of the purchased call option will always be a positive number. It can never be a negative number. It will always be a positive number. That means it will always be potentially favorable to the entity, which means this doesn't mean that you will always make profit. Please don't misunderstand that. I am not saying that if you purchase a call, you will always make profit. No, that's not what I'm saying. What I'm saying is that it will be an asset all the time till the date of settlement, when you will realize that it is not an asset, but it is a worthless asset. It can never be a liability. There is a point here. So you have something. This is the limb which talks about the derivatives. So all the derivatives or financial derivatives are covered under this limb, which says that to exchange financial assets or financial liabilities under conditions with another entity under conditions that are potentially favorable. So potentially favorable means it has got to be a purchase call option. So all the derivatives, all the derivative contracts which has a positive value will be covered under this definition of to exchange financial assets. Okay. Then comes the another item, which again is a contract, but here this contract is slightly different from the earlier contract in the sense that the contract is settled by the entity's own equity instrument. So if you are talking about A Limited, so we are saying that this A Limited, okay, this A Limited has a financial asset, has something that it has got to receive, but this is going to be settled by A Limited's own shares. So if that is the case, then will it be treated as a financial asset? Depends upon this one, whether you are going to receive, if you are going to receive a variable number of your own equity instrument, then it is a financial asset. You have to receive a variable number. Then a derivative that will be settled other than by exchange. Other than by exchange of fixed means it has got to be a variable. So it should be a variable number for a fixed number of entities own equity instrument, but what you receive is a variable number. Okay, now let me give you an example of this one. Okay, example is here itself. Okay, we have an example. Now let us assume that there is a financial asset. Okay, now this financial asset, it has to receive this company has to receive this financial asset. Now this has to receive 5 lakh rupees. It has to receive 5 lakh rupees. Now there are various choices available with this company, with this entity. It can get 5 lakh cash now, which means it is obviously a financial asset because you have to receive based on a contract, based on receivable. Let us assume this is trade receivables. So you have to receive this 5 lakhs. So obviously it is a financial asset. Now, instead of that, the other party, the counterparty, tells you that instead of cash, I will give you your own shares. So A Limited says, okay, I will take my own shares, but I will ensure that I always get a value of this 5 lakhs, irrespective of when this is going to be settled. If it is going to be settled today, based on the fair value of the share, now this is the fair value of the share or called the intrinsic value of the share, based on the intrinsic value of the share, I will decide the number of shares in such a way that the value that I obtain from this one is always equal to 5 lakhs, which means today, assuming that it is 100 rupees per share, I will have to receive 5,000 shares. If I receive it tomorrow, the settlement date is tomorrow. Okay, tomorrow means some future date. Okay, and if my rate goes up to 125, I'm okay to receive only 4,000 shares because I will then be getting 5 lakh rupees value. That is the value that I obtain. But on the other hand, if day after tomorrow my value of my share goes down to 80 rupees, then you have to compensate me to the extent of 6,250 shares in such a way that I get 5 lakhs. So if this is the case, you can see here the number of shares here is not fixed, but instead it is a variable. So here, that is what the definition says. The definition says that you are going to get a variable number of shares, then it is a financial asset. It is a financial asset if you are going to get a variable number. Now let us go to the next slide. It says that if on the other hand I am happy with getting a fixed number of shares, then I am willing to take the risk on the value of my own shares because I know I'm confident that my rate will only go up. So it has actually gone up to 125 rupees on settlement date 1. So I will actually be getting a value of 6,25,000. But unfortunately, if the value of my shares goes down, I will be receiving actually a lesser amount, which is okay with me because I am going to take the risk and the reward of this deal. So the risk and the reward, whoever has the risk and the reward means that they are the ones who are actually treating it as equity. The other person, in this case, the previous one, the person doesn't want to take any risk or the reward. They says that I want always my value to be equal to 5 lakhs, then it will be a financial asset. So if it is a variable number of shares, it is financial asset. If it is a fixed number of shares, here it is a fixed number of shares, then it is part of the equity. That's how it will be treated. So that is what is explained here. So here it says that receiving a variable number of entities own equity instruments. Now this is the essence, this is the crux of this standard. So if you understand this, 50% of the standard is covered. Okay. If it is a derivative, exchange of a fixed amount of cash for a fixed number other than, that means it is a variable. So other than, so this is a key word which says that other than exchanging fixed amount, which means it is a variable amount. So in this case, it becomes a financial asset. Okay. Now, there are, you just understand what is a financial instrument or non-financial instruments. I think these things, you know, these are financial instruments. Why? Because this is arising on account of a contract. There is a contractual right to receive cash. There is a contractual right to receive cash. Investment in shares and cash are specifically given as a part of the definition. Receivables, right to receive cash. Loaned entities, right to receive cash. Investment, right to receive. Deposit, right to receive. Derivative financial assets, covered specifically so long as it is a positive. If it is negative, it is not a financial asset, then it becomes a financial liability. Trade receivables, financial asset. Trade payable, financial liability. So it is a financial instrument. Interstate swaps is a financial asset. If it is positive, it is a financial liability. If it is negative. Okay. Inventories, machinery, property, all these things do not give you the right to receive cash, even though ultimately it may be converted, but it is not a right to receive cash. So this is not a financial instrument. Now this prepaid expenses also, normally you don't have the right to receive, but instead it will be adjusted against the actual amount, actual nature. Like for example, if it is a prepaid rent, right? So it goes towards adjusting with your rent. So you don't have normally the right to receive cash. Advance for goods, similarly GST, advance tax. This is arising not on account of a contractual right. That is the reason why this is not a financial instrument. There is no contractual right. That is why it is not a financial instrument. Bank balance, yes. Shares, subsidiary company, yes. Advance given, no, because it is normally adjusted against your purchases. The investment in debt, yes, you have a right to receive. See, the perpetual debt also, the perpetual debt means you can argue that you won't get the money back, but that's not the case. But in perpetual, you are getting interest at fixed rate. The present value of all the future cash flows will be equal to the value of the debt. So this is the financial instrument. Prepaid expenses, no. Deferred tax, no. Contractual. Lease deposit paid, no. Lease deposit paid, yes, it is a financial asset. Okay, very important. Contract to deal with the non-financial asset is not a financial instrument. It's not a financial instrument, but it will be treated as though it is a financial instrument if these conditions are satisfied. Okay, it can be settled net in cash, exchanging for financial instruments, or it is readily convertible into cash. Financial liability is just the the other side of the same coin, which is financial asset coin. So the financial asset coin, the other side is financial liability. So there it was a contractual right. Here it is a contractual obligation. There it is a contractual right. Here it is a contractual obligation. There it is to receive cash. Here it is to deliver cash. Here you have to deliver cash. Again, this one is exactly the opposite. To exchange financial assets under conditions that are potentially unfavorable means these are sold options, sold call option, sold return means sold call option or sold put option. Again, coming to the liability, which will be settled in the entity's own equity instrument. So we already saw that here, if it is by delivering a variable number of the entity's own instrument, it is a liability. Whereas if it is a fixed one, so other than by way of fixed means if it is a fixed one, then it becomes an equity. If it is a variable number, it becomes a liability. That we already saw the example also. So tax liability, no, because there is no contract. Finance lease obligations, yes. Non-refundable revenue, no contract. Non-refundable advance against the sale of government securities. Liability for damages, no, you can't get under as a part of the contract. Deferred revenue, financial guarantees given, yes. Okay. So this is the chart which tells you the classification. Okay. The first question is, does it contain an obligation to deliver cash? Okay. If there is no obligation to deliver cash, if the answer is no, then it is equity. Straight away you can take it to equity. However, if there is an obligation for the issuer to deliver cash, if the answer is yes, then further questions are asked. So it is only at the time of the liquidation. Okay, if it is at the time of the liquidation, so then there are certain specific conditions that are given in the standard. So if those conditions are satisfied, then it is equity. Obviously it is equity. If those conditions are not satisfied, it becomes liability. Here in this case, if it is not a puttable instrument, if it is no, then the question is, does the instrument contain any equity component? What is an equity component? Equity component means like a discretionary dividends, etc. If it contains any equity component, then it becomes a compound instrument. So like for example, you have the right to receive some equity shares. You have a debt instrument, but the debt instrument, you have a right to receive some debt of some equity instruments, then it becomes a compound instrument. And what you need to do is to do split accounting. If it is not, then the entire amount will be treated as a financial liability. Now we will see some examples of this shortly. Obligation to deliver cash. So we have seen that. Okay, obligations to deliver cash. Potentially unfavorable, I have explained this. Return call options are potentially unfavorable. Okay. Now the reason I have made one more slide for this one to make you understand. Return call option, it represents an obligation to sell an item at a specific price. Always remains a liability. Put option always remains a liability if it is a return option only. If it is a sold option, it is always an asset. Okay, equity instrument. Now the equity instrument is no contractual obligation to pay cash, to deliver cash. So long as there is no contractual obligation to deliver cash, it becomes an equity. That is the first condition. The first condition is this. Okay. The second condition is, how many shares are you going to issue? So how are you going to settle? If an instrument is going to be settled by the issuer's own equity instrument, so you have got some money, some issue proceeds, and you need to settle that. In order to settle that, you are going to issue your own equity shares. If that is the case, then how are you going to decide whether it is a equity? It contains no contractual obligation for the issuer to deliver a variable number of its own. So if it is a fixed number, then it is a fixed number for a fixed amount, fixed number for a fixed amount. Both are FF, then it will be an equity instrument. If it is a variable, then we already saw that it becomes either a financial asset or a financial liability, depending upon whether you have to receive or pay. So very important here. So contract that, so the see, ultimately, you know, if you translate this, if you translate the definition, it translates into this one, that this is a contract that evidences a residual interest in the net assets of the entity. So equity shares, some preference shares, okay, some warrants, return call options to issue a fixed number of equity shares for a fixed price. All these things are examples where it evidences a residual interest in the net assets of the entity. So if there are multiple components, there are two components, then on initial recognition, you have to bifurcate this into the equity component and the liability component and account for it separately. Okay, now we'll see some example also. So the question is, does the entity have an unavoidable contractual obligation? Yes, there is no unavoidable. There is an unavoidable contractual obligation. Then it is a liability. Otherwise, it is an equity. If the answer is no, it is an equity. Okay, that is the condition. Now the second one is, the second condition is about the variability. So how are you going to issue the number of shares? Now, beautiful example given. This is given in the standard itself. A contract is not an equity instrument solely because it may result in the receipt or delivery of the entity's own equity instrument. So it means that, okay, I have already taken a loan of say 5 lakh rupees and I want to issue shares to that extent. Just because you do that, it doesn't mean that it becomes an equity instrument. You have to understand how many shares are going to be issued, what is the basis of such issue. Now, there are two examples that are given. One, a contract to deliver as many of the entity's own equity instruments as are equal to the value of 1000. Okay, so that means you don't know the number of shares that you're going to issue, because the number of shares will depend upon the value of your own equity instrument. Then in that case, the number is variable. If it is a right? So then it becomes a liability. If it is a variable, it becomes a liability. Now, another case, a contract to deliver as many of the entity's own equity instruments, so you don't know the value, so it is variable, as are equal to the value of 1 kilogram of gold. Again, you don't know what is the value of 1 kilogram of gold. So there are two unknowns. Two unknowns doesn't make, two negatives or so two negatives make positive, but two unknowns doesn't solve the equation. So two unknowns are still unknown, which means it is still variable. So that means it is a liability. So in this case, the example, the answer is, it is not an equity instrument because the entity uses a variable number of the instrument and it uses the equity instrument as a currency. So you are actually using your equity instrument as a currency to settle the contract. Such contract does not evidence the residual interest in the assets, and that is the main reason why it will be treated as a liability. Any questions so far? Okay, so So you are not able to type out anything on the chat box. Is that prohibited, or I don't see any message? Okay, we will leave that. I'm not going to waste time on that. I hope you are able to listen. You are able to understand. You are okay. Okay, now see this liability versus equity. The criteria for classification. There are some key points to be noted. One is the criteria does not depend, or it is not impacted by, it is not impacted by the history of making distributions, intention to make a distribution in the future, possible negative impact on the price of the shares, the amount of the issuer's reserves, issuer's expectation, ability or inability of the issuer to influence the amount of profit. So none of those things are going to determine the classification into equity or liability. What is important is just that the conditions that we saw. One is whether there is an unconditional right to pay or not to pay. So if there is no necessity for you to pay cash, then it means that it is part of equity. That is one. And how many shares are you going to deliver? Are you going to deliver a variable number of shares? If you're going to deliver a variable number of shares, it is actually a liability. If you're going to issue a fixed number of shares for a fixed amount, then it is equity. So that is the one that will drive the classification criteria, and this is very, very important. Okay. Now let us see one example. Company issues non-redeemable callable bond with a fixed coupon. Now the coupon can be deferred. Coupon can be deferred in perpetuity at whose option? At the option of the issuer. However, A has a history of paying the coupon each year, so it pays regularly. The stated policy also says that coupon will be paid, and it is also available in the public domain that they're going to pay, whether it should be classified as liability or equity. Now here, the main point here is that the coupon, this is the key point, the coupon can be deferred in perpetuity at the option of the issuer, which is A. That means even though they are paying the coupon, the company A is paying the coupon, since there is a right on the part of the company to defer the payment of this coupon, this will be treated as an equity and not a liability, because there is no need for it, because it is already non-redeemable callable bond. So there is no need. If only A wants, it can call the bond and pay money. Otherwise, if it doesn't want, it doesn't have to pay. That means there is nobody can force the A to make the payment. That is the key point. A can make the payment on its own, which is fine, but no one can force. No one can force, because there is no contractual obligation to pay. There is no contractual obligation to pay. Okay. Now the next one is A issues an undated preference shares with 6% dividend. So wonderful credit rating of AA, market rate of interest 5.5. The shareholders may not redeem the preference shares. The shareholders doesn't have the option to redeem. However, A may repay. After the 5th year, if not repaid by A, annual dividend on the preference shares is stepped up to 20%. From what? From 5.5%, it gets stepped up to 20%. So there's a steep increase. Okay. Entity A has the full discretion on dividend distributions. However, it may not pay the dividend on its shares, ordinary shares, before paying the dividend. Now, is it going to be a liability or an equity? Now, here again, there is no obligation on the part of A, because it is an on the part of A to make the payment. Okay, so here the entity has an obligation to redeem the share in the 5th year, as the entity can replace it with a cheaper finance. The preference finance should be classified as equity instruments, since the entity has no contractual obligation to redeem, even though it may redeem, because after the 5th year it has to pay 20%. So in all probability, A will redeem on the 5th year. So that is very, very clear from the terms. But there is no contractual obligation. Contractual obligation is not there. So the fact that not paying dividend, what will happen? Not paying dividend on the equity shares will have a serious effect on the entity's share price, which is fine. But as far as this instrument is concerned, it will be treated as an equity instrument only, because there is no obligation to pay. Here again, no contractual obligation. Okay, same answer. Now, there could be some contingent settlement provisions. These contingent settlement provisions also cannot be taken as a hood for the classification. Okay, so here the instrument will still be a liability unless the part of the contingent settlement provision is not genuine. Otherwise, it will still be treated as a liability. Okay, now I think there is okay, here let us see one example. A cumulative convertible bond whose interest payments are at the discretion of the entity. It contains a clause that states that instrument, including all unpaid cumulative interest, will become mandatorily payable if there is not an IPO by the end of 3 years. Now, this is the contingent condition. There is a contingent clause. The contingency is that it has to come up with an IPO by the end of 3 years. Okay. Although it may be within the entity's control to determine whether the IPO is attempted, it is the market and the regulatory forces will determine whether this attempt is successful. The IPO has to be successful, is not within the control of the company, but it is it is decided based on the market and the regulatory forces. Okay, so these forces are beyond the control of the entity. So these are genuine. So that means therefore the redemption of an IPO event not occurring meets the definition of a contingent settlement, and the bond is classified as a financial liability. Okay, because you may or may not be able to come up with an IPO because that is not in your hand, and so this will be treated as a financial liability because it is a contingent condition. Okay, now I think so variable number, we have explained this variable number concept. Okay, this I have already explained. Okay, now the monetary value fixed, variable, financial, variable, fixed, financial liability, variable, fixed, financial liability. Then this also is a financial liability if it is in other fixed in a currency other than the entity's functional currency. It's also a financial liability. Fixed alone will be an equity. Okay, we will see one example for the convertible. Okay, these are examples which we have already seen. Okay, I just want to okay, now let us see this example. Okay, now R Limited purchases a call option from Z Limited on 1000 of R shares, its own shares. Okay, and the strike price is 103. The call premium is 6 rupees. So that means the call option expires in 6 months' time. The current share price is 100 rupees. The strike price is 103. The premium paid is 6. Okay. Now the price of our share shot up to 110 just before the expiry of the call option. So how is this transaction accounted? First thing is, how will you account for this call option premium paid? What is the premium paid? 6 rupees into 1000, or the premium paid is 6000 rupees. So how will you treat this 6000 rupees? That will depend upon whether the underlying transaction is considered as a liability or an equity. Now here, the total number of shares is fixed, which is 1000. It is fixed. That's what it is going to get back. The amount which it's going to part with is also fixed, which is 103, because the strike price is 103. So both these are fixed. So it is of the nature of equity instrument only. So settlement through own equity instrument. The contract is a derivative contract. The contract is settled by exchanging a fixed sum for a fixed number. Both are fixed. 103 is fixed. 1000 number of shares is fixed. So this will be an equity instrument. Because it is an equity instrument, the call option premium paid of 6000 rupees will also be taken to equity. It will not be expensed. That's a key point here. So here the entry is the 6000 rupees is debited to equity, and what you get, because it is a I'm sorry, what you pay is 6000 rupees on account of this, that will be credited. 6000 is credited. Okay, now the price of this share rose to 110 rupees. Okay, it is your own shares, so you do not make any entry because you don't recognize the profit on your own shares. So there is no entry that needs to be passed. But here, on the date on which the expiry, on the date of expiry, you will have to pay how much? 103,000 and debit that to equity and credit 103,000 rupees in cash. Now the rate shot up to 110 rupees has got nothing to do with this problem, except to ensure that R is going to exercise this call option, because the market rate is 110, your strike price is 103. Obviously it is in the money, so this is in the money call option. So R will exercise this call option and opt for taking delivery of these shares. So equity is debited. Okay, now I just want to tell you one more thing here. Supposing this at the time of the on the expiry date, let us assume that the price of our shares is 96 rupees. What would have happened? If it is 96 rupees, obviously R would not have exercised this option, because it will expire worthless. So nobody is going to expire, because this call option would have expired worthless. But this 6000 rupees which was passed, taken to the equity, will remain there. This entry will not be reversed, but instead just whatever is debited to equity of 6000 rupees will continue to be there. This entry will continue to be there, irrespective of whether the contract materializes into lifting your own shares or not. Okay, so that is a key point here. T Limited issues a debt for 10 lakhs. The debt is repaid using its equity shares to the value of 10,000. Sorry, the value of 10 lakhs, which means here these shares are used as a currency to settle, irrespective of the value of its own equity shares. It will always part with the value to the extent of 10 lakhs. So this will be a liability. This is a liability. Okay. Now, okay. I think now we will do one thing. Let us. I think you have understood the essence of this one. So what I suggest is that we will go to one instrument. I just want to show you one instrument where it is both it's a compound instrument. Okay, that's just one instrument. Okay. Now here, the compound instrument and then we will move on to 109, because 109 we have a lot to cover. Now, this convertible instruments, these are convertible instruments, compound instruments, are financial instruments that fall within the scope of Ind AS 32. Generally, such instruments are either be classified as equity or compound instruments or hybrid instruments, liability with embedded derivatives. All the three combinations are possible. Okay. Now, the derivative contract involving the delivery of the receipt, okay, of a fixed number of equity instruments or a variable number of own equity instruments or net share or cash settled contracts, okay, or a financial. The derivative financial instrument with settlement options is a financial asset or liability unless all possible settlement options would result in the classification. Okay, now let us go to one example here. Okay, now the company issues, there is an issuance, and that issuance is 2000 convertible debentures. 2000 convertible debentures, 1000 rupees per debenture. So the collection proceeds is 20 lakhs. Collection proceeds is 20 lakhs. Now, this pays interest at rate of 7%. Each debenture is convertible any time up to maturity into 250 equity shares. If this does not happen, the holder has an option to receive cash. So that means there is a liability to pay cash. So if the holder does not convert the debentures into equity shares, the company will have to part with this 1000 rupees. Okay, so that means there is a component which is a liability. There is also a component which is treated as a equity, and this is treated as a compound financial instrument. So there is a call option. The investor has a call option to receive 250 equity shares. There is a call option. It can be exercised by the investor. So as far as the company is concerned, the company has to find out the liability component and the debt component. Now, how this will be found out? You need to find out what is the market rate of these kind of debentures. So the market rate, you will find out this based on the risk-free rate plus the credit risk or the credit spread on the issuer. Now this 250 basis points is the credit spread, which is equal to 2.5%. So 2.5% is the credit risk and 7.5% is the risk-free rate. So totally a similar instrument without the conversion option should be available in the market at the rate of 10%. So the investor is willing to sacrifice 10% minus 3% as because the investor has a right to receive or to right to receive the shares of the company. So there is a call option. Call option is the right to buy the shares. Okay, so that means there is a call option. So that is the reason why the interest rate is low. So now you assume that 50,000 rupees is the transaction cost. Now let us see how this is dealt with. Okay, first thing is there is a annual coupon payment component 7%. Okay, that is obviously a liability. Then there is a conversion feature. This conversion feature, there is no contractual obligation to pay cash. The component can be settled by the entity issuing its own equity instruments if the option is exercised by the holder. Now this component is a derivative component. The derivative may be settled by the entity by exchanging a fixed amount of cash, which is 1000 rupees, for a fixed number of its own equity instrument 250. Therefore, this component is equity. So this component is an equity. So you need to split these two. So how do you do that? first measure the liability component first, okay, by discounting the liability at the normal discount rate of 10%, which is the market rate. How do you get this 10%? 7.5 plus 2.5. Then, so here what I'm doing, here I am splitting this. So these are all the various cash flows, interest, principal. These are the two cash flows, right? This is the total cash flow. The discount factor is based on 10% is the discount factor that is applicable. So based on the discount factor, find out the present value and also find out the transaction cost. So the net amount is 1804 and the value of the equity component, the value of the, so the value of the total issue profits is 20 lakhs. So the value of the equity component is the difference between this 1850, which is your liability or the liability component, and 149,211 is your equity component. Okay. Now this transaction costs are also allocated on a pro rata basis, and the net amount. So the amount at which this liability will be recognized in the books will be 1804, and this will be the amortized cost. It will be classified as amortized cost. So the value of the equity component will be 145,481 will be the value of the equity component. Okay. Now this 1804, which is the amortized cost, look at this number 1804. This number will be amortized based on the effective interest rate. We will shortly see what is an effective interest rate, and the transaction costs are also amortized, and this will be the closing liability. So at the end of the period, the closing liability will be equal to the issued profits, which is 20 lakhs. Okay, now I think we will stop with this one, and it is exactly 5:30 now. So we will take up. Let us take up the classification of financial assets. Okay. Now, before we do that, can we have a 5-minute bio break? Yeah. We'll have a 5-minute break and resume at what is the time now? 5:31. We will resume at 5:37. Is it okay? 5:37. Let us resume. Okay, let us let us resume. So before we go into Ind AS 109, we will quickly see the basic accounting entries required for financial instruments. Okay. Now this is must be very basic for you. So for most of you, this will be basic stuff. Okay, but I thought I will still do this one. So here you have to compute what is called as the effective interest rate. Okay. Now this effective interest rate is something that is calculated based on what is called as the IRR. So in our Excel you have this IRR. So you have the cash flows. Based on the cash flows, you find out what is the IRR. Okay. Now, so here you start with the beginning year. So the amortized cost is say 1,000. You add the interest. You find out what is the effective interest rate. The effective interest rate. Let us assume here in this case the effective interest rate is 10%. Apply this 10% on the opening amortized cost. So that will give you the total amount of income, effective interest. Okay, but then the company pays you interest, so that interest has got to be reduced, and you will get the closing amortized cost. Okay, ultimately at the end of the period, you will have the face value or the maturity value which you will receive from the company. Now let us take one more example here. To specifically, what I will do is let me show that calculation separately. Yeah. Okay, not this. Yeah. So, so if you look at this table, now let us assume that the principal is say 100 rupees. The maturity date, the current date is the date on which you purchase this is say 1st of Jan 2019. The maturity date is 31st December 2023, which is 5 years from now, 5 years from the date on which you bought. And let us assume that the price at the date on which you bought is say 85. So you will be getting 100 rupees back from the company. So previously, as per the IGAP, we used to treat this difference between 85 and 100, which you receive back from the company, as capital gains, because your original investment was only 85 and you get back 100 rupees back from the company. And you would have shown 6%, which is 6 rupees from this instrument as interest income. So this instrument would have shown an interest income of 6 rupees continuously. And then finally, on the last year, which is year ending 31st December 23, you would have received 15 rupees as capital gains. But that is completely wrong, because this 15 rupees, which is the difference, which is the discount from your maturity value or the principal value and the current cost, the price at which you buy, the difference between these two actually represents interest income. That is the concept here. So you need to find out what is your effective interest. The effective interest is computed as the IRR, okay, which is also known as the EIR, IRR, or yield to maturity. In Excel, you have this IRR formula. So apply the IRR formula on the various cash flows. So on day one, the cash flow is minus 85 because that's what you're paying. And then what you receive is all positive, 666, all these positive numbers. So the total amount of cash flows will be discounted at an effective rate, which will give the present value equal to 0. So that is how this IRR is defined. So it is the rate at which IRR is the rate at which if you discount all the cash flows, you will get a present value of 0. Now here applying this 9.95%. So what I'm doing, I'm applying this interest income on the opening balance of 85 rupees, which is called as the amortized cost. Apply this on 85. So this is your effective interest, or this is your interest income. However, you will be receiving 6 rupees as coupon from the company because the company pays you 6%. So reduce that, and the difference between these two is added to the amortized cost. So your amortized cost becomes 85, becomes 87.46. For the next year, you compute interest income at the same rate of 9.95%, but on the opening balance, which is 87.46, and reduce from this, reduce the interest what you receive, cash what you receive from the company. So difference between these two, 2.7, is added to this. That is how you get. Finally, if you keep on doing this, finally you will be left with 100 rupees at the end, which will be the amount that you will be receiving from the company on maturity. So this is how this amortized cost is computed. Okay. Now for just for the heck of it, what we will do, we will change the price to say 106. Okay. Then you will see that the effective interest rate actually falls below 6 rupees. But nevertheless, this amortized cost at the end of the period is 100 rupees. So this is your effective interest income you will be booking. The present value will always be equal to 0. Now, if I make this as say 120 for that matter, okay, you will still see the same thing. So here the interest, actually what effective interest or your yield on this will be only 1.78%. And that is all the interest income that you will be booking in your books. So on the other hand, if it is 85 rupees, you will see that your effective interest is more than the coupon because you are getting it at a discount. So you please understand this concept, because if you have understood this concept, you will be able to understand, because this concept is applicable not merely in financial instruments, but all the other standards, Ind AS standards also the same effective interest component, effective interest principle is applied. Now, I just want to tell you one thing. If the price is also equal to 100, what will happen is that the amortized cost will always be 100. Okay, very key concept. This key concept I will be using in one place shortly from now. So if the price paid and the maturity value, if both are the same, the amortized cost will be the same throughout, and your interest income, effective interest income, will be equal to the coupon. Now it is 6%, so here 6%, 6%. You can see both will be the same. Okay, that is the important corollary which I want you to focus on, which we will be making use of in our computations now. Okay, now let us see this problem now. Okay. We can go through this very quickly because this is only some accounting thing. So here there is an investment in equity shares. Investment in equity shares at the rate of 850, 100 shares. Market rate 875. Now the investment should be shown in the balance sheet at the market rate, and the fair value changes of this should be taken to P&L. Okay, normally, because it is for trading purposes, the classification is FVTPL, you have to take it. Okay, now let us see the entries. Investment account 85,000, bank 85,000. Investment account to unrealized gains, because the market rate is 87.5. So in the balance sheet it is shown at 87.5, and unrealized gains in terms of fair value change, these are fair value changes to your instrument. This is shown in the profit and loss account. Then This is a case of debt security, bond. That is, bond means debentures. It is at 85 rupees, 1000 bonds, 2.6%. The same example, what we saw, 85 rupees, 6%. So, but the market rate is 89. The classification is trading. So if it is trading purpose, you can say, take that the classification is called fair value, FP, TPL. That is fair value through P&L. That is what we are going to account for. So now, first entry 85,000, 85,000 investment account. Second, it is bank. You get 6,000 from the bank by way of what? By way of interest. Then prepare this effective interest rate chart. Okay. Then find out the amortized cost at every period, or the carrying value or amortized cost at every period. In the last period, it is actually 100 rupees because you will get the 100 back, so it becomes 0. So the account for the interest income over and above the interest income of 6 rupees which you receive from the company. So you have to account for what? 8.46 minus 6, 2.46. So that is the entry that you will pass. Investment account to interest income. So 2460 is part of your interest income. How did I get this? 8,460 effective interest less 6,000 which you have already received from the company. So then your carrying value, what will be your carrying value? Your carrying value will become 87.46. Now this carrying value is what you will compare with the market rate. The market rate is 89 rupees. So the difference between 89 rupees and 87.46 will be treated as your capital, fair value changes. So that is what is treated here. Unrealized gains on bonds trading 1,540, and in the balance sheet is presented as 89,000 will be what is presented in the balance sheet because this is shown at fair value, and it consists of the breakup is interest income is 8,460, unrealized gains is 1,540. I hope it is clear. Then this is a case where it is held to maturity. So this is classified as amortized cost. same set of numbers. Okay, only the classification is different. So investment account, this is called amortized cost investment account. Then 6,000, same 6,000, pass entry for this. Then prepare the table. Then pass the difference for this 2,460. That also no change. And you will not account for the unrealized gains here, but this will be shown at amortized cost. This 87.46 you saw there, that is the amount that will be shown in the balance sheet. So interest income, same 8460. Only thing what is missing here is the P&L on account of the changes in the fair value, because that is not recognized in the case of amortized cost. Okay, we are going to see all that in great detail. Just don't worry, we will see that. But right now, try to understand this. So here, this is a case of where the classification is FVOCI. That means it is taken to the other comprehensive income. So same set of example, same set of numbers. No change, no change, no change. Same, but the only change here is this unrealized gains is taken to the other comprehensive income. It is not taken to the P&L, but instead is taken to the OCI. That's the only change here. So the presentation here is it is shown as part of your other comprehensive income here, and the balance sheet it will be shown at fair value only. Okay. Okay. Now let us move on. Let us go to the essence now, which is the Ind AS 109. Okay. Classification and measurement. The first thing is classification. Okay. Now, financial assets, classification of financial assets. Classification of financial assets. First is it an equity instrument? If the financial asset is an equity instrument, then there are only two possibilities. One is it can become it can actually be classified as fair value through profit and loss account, or it can be fair value through other comprehensive income, that is FVOCI or FVTPL. These are the only two possibilities that are possible in the case of equity investment. So the first question is, if the answer is yes, then the question is it held for trading purposes? If it is held for trading purposes, the classification straight away is FVTPL. If it is no, then you have a choice. This choice is given. This choice is given, but the choice is irrevocable. You can elect it to be classified as FVOCI. If you elect that, then the classification is FVOCI for equity instruments. Okay. If you don't do this, if it is not held for trading, if it is held for trading purposes, then obviously it is FVTPL. Okay. Now, if it is not an equity investment, then obviously it has got to be a investment in debt security, right? It has got to be an investment in debt security. So if it is an investment in debt security, the question is, are these assets the contractual cash flows solely payment of principal and interest? First thing you need to find out, what are the characteristics of the contractual cash flows arising on account of this investment? Does it represent solely payment of principal and interest, so which is called as, also called as Sppa test, solely payment of principal and interest? So this test is applied at what? This test is applied at the instrument level. So that means if the instrument passes this test, Sppa test, then it passes for everybody. It passes for you, it passes for me. Okay. Now, what does it mean? Let us try to understand what is this Sppa test. Normally, an instrument pays interest and also the principal at the end of the period. So these are the two types of cash flows that you can expect to receive from a financial asset. From a financial asset, these are the two types. Now, this interest means interest is predominantly a consideration for time value of money. If it is anything else, then you cannot call it as interest. Like for example, I will give you an example. You bought the debentures issued by Tata Motors Limited. Okay. It carries a coupon of say 11% coupon. So this 11% is paid twice a year. That is, every 6 months you get 5.5%. So that is how this instrument pays, and it has a maturity of say 15 years maturity from now. So at the end of 15 years, you will receive the principal back. So the cash flows that are associated with this are the 11% coupon and the principal. So this instrument satisfies the Sppa test, which means the cash flows represent solely payment of principal and interest. Now, on the other hand, let us assume another instrument issued by ABC Limited. The conditions are ABC Limited will pay, it is also called as interest, but it will pay interest at the rate of 6% if Nifty stays below 17,000. If Nifty trades below 17,000, it will pay interest at the rate of 6%. If it trades above 17%, Above 17,000, then interest will be paid at the rate of 15% per annum. Then in this case, this is not a consideration for time value of money. You cannot call this as interest, even though it is reckoned as though it is a time value of money, but in reality, it cannot be called as interest because it is not a consideration for the time value of money. So the SPPA test here fails. If the SPPA test fails, then the classification will be FVTPL only. If the SPPA test passes, then it qualifies for the next test. So if it fails, it is FVTPL. If it passes, then another question is asked: what is the business model objective? To collect contractual cash flows only? Is the business model objective of holding this instrument to collect contractual cash flows only? If the answer is yes, then the classification is amortized cost. If the answer is no, then you ask one more question: is the business model objective to collect contractual cash flows and also to sell this financial asset once? So that means you are holding it to collect contractual cash flows, but if the time is ripe, if you get an opportune time, then you may be selling this financial instrument. If that is the case, if that is the objective, then this will be treated as FVOCI. If the answer is yes, then it will be FVOCI. So for the first question, if it satisfies the first question, the second question also, then it will be amortized cost. Okay. Now let me reiterate. If it is equity, there are only two possibilities. It is either FVOCI or FVTPL. Now this is arising on account of the choice which the entity can exercise. The entity exercises this choice if the investment is not for trading purposes. If it is for trading purposes, then it is no choice. It will be treated as FVTPL only. On the other hand, if it is not for trading purposes, the entity has the choice to classify this as FVOCI. But once this is classified, it becomes irrevocable. You cannot go back. If it is not an equity investment, it has got to be a debt instrument. So the question is, what does it pass the SPPA test? If it passes the SPPA test, if it doesn't pass SPPA test, it is FVTPL. If it passes the SPPA test, then the second question is asked, where you find out what is the business model objective. If the business model objective is to collect contractual cash flows only, this is very important, only can, then it will be treated as amortized cost. Now this is a this amortized cost is a highly coveted cost. Everybody wants to classify their investment as amortized cost, but then it is not by the choice, by you exercise. It is based, the classification is based on the various criteria, objective criteria that is prescribed in the standard. So if the business model objective is not to collect only contractual cash flows, but also to sell it. When you sell it, how many times you can sell? You can sell only once, right? Because if it is sold, means it is sold. So sell once, then the classification is what is called as FVOCI for debt security. Now you will be wondering why there are two classifications. FVOCI obviously can be the same, right? So there is one FVOCI for equity investment, there is one FVOCI for debt security. So we will see why this is, what is the difference between the two. Now FEOCI equity investment is by exercising the option. FETPL is the residual classification. FEOCI debt instrument is by applying the set of objective criteria. Amortized cost is also by applying the set of objective criteria. Now, any doubts on this one? I don't know. I'm not able to see any doubts. Any questions on this? You will not be able to unmute and talk. Anybody will be able to do that, or that's prohibited?
हेलो
Yes.
हाँ सर हो गया सर आपका
Yeah. What?
सर लेक्चर हो गया कि क्वेश्चन दे दूं सर आपके
No, I'm still doing. No, I'm asking questions. See, the participants won't be able to talk or chat or anything. Huh? Will they be able to chat?
सर क्वेश्चन है दे रहा हूँ सर
There are questions?
यस सर
Yeah, please. How do I see the questions? I don't know. I'm not able to see the question. Where is the question?
तो मैं स्क्रीन शेयर कर रहा हूँ सर आपको
Okay. Oh, it doesn't come here on my screen directly. Yes, bonus shares or split shares, they are also considered as financial asset. Yes, answer is yes. Yeah. The premium paid is debited to equity. Does this amount to reduction of share capital? No. No, it doesn't. Or this amount is reduced from the reserve. Yeah, of course it is. It is reduced from the other equity. You know, the exact classification is other equity. It doesn't amount to reduction of equity. It is actually debited to the other equity. Tell me how classify the investment of in mutual fund units. Mutual fund units. Mutual fund units, it will be, you know, if it will be treated as an investment in debt security only. Even though it is mutual fund, it will be treated as debt security. The fluctuations, the monthly gain or loss will be accounted for in the P&L only. If the asset is held as FETPL, what would be the taxability? FETPL, okay, see, taxability is a different ball game completely altogether. Okay, it is based on the taxation, tax accounting standards. Okay, so here we are seeing this only from the perspective of the Companies Act, where you have to follow the accounting standards and the disclosures as well as the Schedule 3. So this is only from that perspective. Please don't bring the taxability into this one. That's a different ball game altogether. So try to first understand only from the accounting standards perspective here. Any other question? Okay, that's good. I think, you know, there was some question. So is there any doubt on this classification? So whenever on this okay, on the classification part, you have any doubt, please ask me. Okay, now if it is clear, then we will move on. I think good questions I received. At least I know that, you know, it's good. Okay. So now these are the same this thing. Okay, I'm not going to repeat the same thing. What I'm going to do is, if you have understood this classification, we can straight away go into this one where we say, how is this treated? Okay, FVOCI equity instruments, no, okay, very, very important. These are the, whatever I have marked in red is very important. So there is, oh, sorry, I'm not showing my, now I'm showing my screen. Are you able to see my screen? Okay. So now here in this case, there is FVOCI equity investments, equity instruments, no reclassification of gains or losses to P&L on derecognition. Okay. FVOCI debt instruments, it is whatever is taken to OCI is reclassified. Here there is no reclassification. Here it is reclassified to P&L. Okay. Now changes in the value, FVTPL, changes in the fair value is recognized in the P&L. So this mutual funds, someone asked about the mutual funds. Yes, this will be treated as equity, investment in equity only. It will be treated as FVTPL only. Okay. So amortized cost, amortized cost. So this amortized cost, there is no need for recognizing the movement of the fair value changes. Only the interest will be taken into account. Okay. So there is no need for the fair value changes for amortized cost. Okay. Now I just want to ask you one question here. So this is what I said. So this, if it is equity instrument, okay, please listen very carefully. If it is equity instrument, this is not recycled. It is not recycled. If it is a debt security, this one is recycled back to the P&L. Okay. So very important to understand this distinction between the two. The reason is because, you know, this one itself is on account of the choice that the entity undertakes. So entity has undertaken to classify this as OCI, FVOCI. So if you say that, you know, you will keep this in OCI only so long as you have the investment, and if you sell it, it becomes, you have to recycle it back to the P&L. The very purpose is not achieved. So that is the reason why it is not required. It should not be recycled back to the P&L. Whereas in the case of debt security, it should be recycled back to the P&L. Okay. So that is very important. So this I have already explained to you how this is computed, EIR is computed. Now EIR, there are certain things how to compute this EIR, because, you know, there are certain costs, transaction costs, which are integral part of computing the EIR, and there are certain types of expenses which are not to be treated as part of the EIR. So this is origination fees. These are part of integral part of EIR. Origination fees, the compensation for evaluating borrowers' financial condition, evaluating and recording guarantees, collateral arrangements, negotiating the terms of instrument, preparing processing documents, all those things are part of EIR. Whereas the fees paid for servicing the loan, no. Loan syndication fees received by an entity, no. So these are not to be treated as part of the EIR. So EIR computation has to be very carefully done. Okay. Sppa test. So instrument B is a bond with the stated maturity date. Payments of principal and interest are linked to the debtor's performance and to equity index. So debtor's performance means, it says that I will pay interest at the rate of 12% if your debtor's balance, receivable balance is X. If your receivables balance is Y, then I will be paying 20%. That is the case. This is not a consideration for time value of money. Equity index, I already gave you the example of equity index. So you pay interest based on the movement of Nifty or say Sensex. It is not. It is definitely not a part of the Sppa test. Sppa test is not. Definitely, it is not satisfied. It is not satisfied. Okay. So that is the answer. Then another example, instrument C is a bond with stated maturity date and pays a variable market rate of interest. The variable rate is capped. So the answer is yes, the contracted cash flows has a fixed interest rate and an instrument has a variable interest rate or payments. So here the interest reflects the consideration for the time value of money and for the credit risk associated with the instrument. So this will be treated as though Sppa test has passed. So in this case, Sppa test is passed. Now the second test is business model objective. So this business model objective is not dependent on the management's intention and ability. Now I have put this very specifically because previously we had this as a condition. So I told you at the beginning, IFRS 9 has become more principle based and it is not subjective. It is now completely objective. So previously it used to say intention, ability. Both these are very subjective. What is intention? Nobody can define intention. What is ability? Nobody can define. So that is what now it is removed. It is not, business model test is not instrument by instrument. It is assessed at a high level. High level doesn't mean it is at the entity level. It means it is at the portfolio or sub portfolio level. So the entity can have more than one business model for managing the financial assets. So there can be a FVOCI, there can be a FVTPL, there can be an amortized cost classification. All the three are possible. Okay, standard acknowledgement judgment is needed. Now, an entity may hold a portfolio that it manages in order to collect contracts and cash flows, and another portfolio in order to realize the fair value changes, which means both these are possible. So the key management personnel will decide. So here, it can have multiple models. That's what I wanted to tell you here. Now, very beautiful example that is given in the standard. Okay, very important to know. Now, let us read this very carefully. Company A has a portfolio and which is part of the held to collect. That means held to collect means it is amortized cost. That's what the classification is. So the classification is amortized cost. Please don't use the word HTM. Okay. Now this HTM is completely not there now. You should not be using the word HTM at all. It is amortized cost. Now, a change in the regulatory treatment of these assets has caused this company to undertake a significant rebalancing, which means it is moving from this amortized cost to FVTPL or whatever. Okay, so this is doing. So whenever you have this amortized cost classification, you are not supposed to sell. You can sell only once. But this rebalancing means what? You are changing this. Okay. Now, why this company is doing? Because of a regulatory treatment. Now, this regulatory treatment, because of this, the business model objective does not change. As a result, because it is a one-time event, you can continue to treat it as amortized cost only. Okay. So now compare this with another case. Okay, this another case is where the same company is required by its regulator to routinely sell financial assets to demonstrate that the assets are liquid. That means you need to keep selling. It is not a one-time effort, but you need to keep selling every now and then in order to prove it is liquid. Now you cannot say I am holding this as amortized cost. Instead, you have to treat it as part of your trading portfolio, which means it will be classified as FVTPL only and not as amortized cost. So that is the point here. Okay, beautiful example that is given in the standard. Now, just because you need to hold something till maturity, okay, but to collect contractual cash flows does not mean that you cannot sell. Okay, very important, because the standard does not tell you how to run your business. Running your business is your own prerogative. So you may probably sell whenever you feel that you have to sell. Like for example, the credit risk of the entity may be very high, so you may have to sell, right? So like that, there are a number of exceptions. Those exceptions are allowed. So that means even though it is sold in the middle, it doesn't mean that the entity is violating the amortized cost model. Okay, so that is what is mentioned here. So business model, two examples are there. An entity holds investment to collect contractual cash flows, but would sell in a particular circumstances. Okay, this will not contradict that objective. Sometimes it can sell. Okay, there is no hard and fast rule. It can sell sometimes, but in terms of frequency and in terms of value, it has got to be less. Okay. Now here, entity's business model is to purchase portfolios. It is purchasing portfolios. These portfolios may or may not include assets with incurred loss, with incurred credit losses. Now the payment is not made on a time. If the payment is not made on a timely basis, the company extracts various methods by making contact, etc. So what is the model? What is the business model? Now here, the objective of the entity's business model is to hold the financial assets and collect costs, which means this will be classified as amortized cost only. Okay, just because the entity see what is important here is that there is no trading activity here. The entity does not purchase the portfolio to make any profit by selling them. So that is the key point here. Okay, now we will come to the most interesting aspect, which is financial liabilities. Now I'm going to discuss this financial liabilities. Very interesting, extremely interesting part. This will also cover the seeds for you to understand the hedge accounting, because hedge accounting I'm not going to do in full. I'm going to tell you conceptually the hedge accounting, because we won't have time to do full justice. Okay, so I think I will cover the hedge accounting portion conceptually here itself. Okay, then you will understand that. Okay, now financial liabilities. Financial liabilities is very simple. It is held for trading, means it is FVTPL. If it is designated at FVTPL on initial recognition, it is FVTPL. Otherwise, all other financial liabilities are amortized cost. So it means derivatives are FVTPL. Okay, and if you designate it as FVTPL, you yourself say I want to classify this as FVTPL, then it is FVTPL. Otherwise, it is amortized cost. Okay, so it is very simple. This financial liability classification is extremely simple. Okay, now I want to show you one thing. Like, let us assume that there are two instruments. Okay, there is a debt security available with the company. Please understand this very carefully. Okay, we will also be covering hedge accounting by this example. Okay, now there is a debt security. Company has a debt security. The debt security is for 100 crores rupees. Date of issue, maturity 7 years. Okay, 8% fixed rate. How did you get this fixed rate? Risk-free rate 6%, credit spread 2%, total 8%. Now, the corporate economist, the economist of this company, has said that interest rate is going to go down. It is going to go down from 6% today, because on the date on which it was taken on 1st of April 2015, it was 6%. It is going to go down to as low as say 2%. I mean, that is his view. Okay, it may or may not go, but that is his view. So the corporate economist says it is going to go down. So the CFO is at a loss because the CFO has already got into a commitment to pay interest at the rate of 8% on the borrowings of 100 crores over a period of next 7 years. 7 years. So you understand the problem? For 7 years, there is a commitment on the part of the company to pay interest at the rate of 8% on the debt issued to the extent of 100 crores. That means 8 crores it has to pay for the next 7 years. But then the CFO, the bank tells the CFO, don't worry, we have a wonderful product, and that name of that product is Interstate Swap. So take this Interstate Swap and you will be able to convert this fixed rate into what is called as a floating rate. So that is what you want, right? Because you think that it's going to go down to 2%. So convert this from fixed to float. So you get into an interest rate swap where you receive 8%. Why you receive 8%? Because you are paying 8%. You are paying 8%, you receive the same 8%. So you are quits. But then you pay based on the floating rate. So whatever is the floating rate, you pay. Okay. Wonderful product. So the CFO is very happy that he got one product by which he will be able to ensure that he is not caught with this 8% liability, but instead he will have to pay interest based on the market rate. If the market rate goes down from 6% to 2% as projected or predicted by the corporate economist, then the CFO will be very happy because the company will not lose money by way of interest. Okay. So now the problem here is that if he takes this instrument, please understand this very carefully. The debt security, the classification of the debt security, what is the classification? I already told you that there is only one classification, and the classification for the debt security is amortized cost only, right? However, this interest rate swap is a derivative. The classification is FVTPL. That is the classification here. So you have a FVTPL classification on the one hand and amortized cost classification on the other. Now, what does it happen? Now, the problem here is in the balance sheet, the swap has got to be fair valued. This is what I started the session with. Okay, you have to do the fair valuation of the swap. Now look at the cash flows of this instrument. You will receive 8%. You will pay 6%. So what you pay is less. Obviously, this will be an asset, right? So this will be an asset. Here you receive 8%. You pay less. You pay 5%. This will also be an asset, further asset. Okay. Here you receive 8, pay 6, again asset. Here you receive 8, but you pay 8.5, so this becomes a liability. It turns out to be a liability. You receive 8, pay 9, liability. You receive 8, pay 11. Okay. So you find that how this debt security will be entered in the balance sheet. In the balance sheet, it will always be entered at 100 crores because this is a amortized cost. I also explained to you by way of an example that if the current rate or the current rate is 100, maturity is also 100, throughout the period, it will be measured at amortized cost of 100 only. So if it is measured at 100, the P&L, there will not be any hit in the P&L. Whereas the balance sheet here, there is a P&L hit. So in the first year, there is a profit, second year profit, third year profit, then loss. So ultimately, what you get is only zero. But during the entire course of the 7 years, there is a huge fluctuation like this in the P&L, resulting in the CFO. The CFO has to quit his job and he has to find some other job. He will be checked out by the CEO because the company cannot afford to show such huge fluctuations in the profit. Clear? Have you understood this concept? Now you have got into this hedging instrument, so this derivative or this interstate swap, only with the good intention that it is going to reduce your interest expense, because the corporate economist has said that the interest rate is going to go down. But unfortunately, it has resulted in the CFO losing his job because it resulted in a huge fluctuations in the P&L. So now, what is the problem? So that is what I have mentioned here. Here, IRS or interstate swap is entered into to hedge the fair value of the bond. Bond being an amortized cost liability is recognized at amortized cost. Swap being a derivative, fair value changes are recorded in the P&L. P&L shows wide fluctuations due to the fair value changes of the swap. Swap is not a speculative instrument, but only a hedging instrument to hedge the fair value of the bond. So in spite of this, this is the problem. You understood the problem? So now there is a solution for this problem. The solution is that so this is the actual problem. I have explained this problem in more great detail. So this is the fair value of the swap. So the fair value of the swap results in the P&L account. So minus means here negative. Minus means it is actually a profit. Plus is a loss. Okay. So here there is a profit, loss, etc. Okay. So huge fluctuations. Now the solution is opt for the fair value option. So what do? You also treat this bond as FVTPL. That means you exercise this fair value option to resolve this issue. The entity exercises the fair value option for the bond. So don't confuse this with FVOCI. Okay, FVOCI is for financial asset. FVO means fair value option. So if the entity exercises this fair value option, then this bond will be recognized at fair value in the balance sheet, and the fair value changes will be recognized in the P&L. So here let us see what happens. Here the fair value of the IRS, the swap, we have already seen. Now the fair value of the debt security comes here in the opposite direction. So the P&L impact, it will be zero impact the P&L. P&L, you can see here, the entire thing is zero impact in the P&L. So the CFO will get back his job once again. Is it clear? Are all of you with me? So the problem is solved, at least temporarily, by exercising this fair value option. Now I'll tell you what is the problem here? The problem is this fair value option is irrevocable. Once you exercise this fair value option for the hedged item, which is the bond or the debenture, you cannot go back and say, I want to value this back at fair value. At amortized cost. No, that is not possible. Till the life of the asset, till the life of this liability. Life of this liability is to the 31st March 22. You have to live with this one, that you have to value this on a fair value basis. So now let us see what happens because of this. Okay, because of this, due to some extraneous circumstances, this interstate swap is terminated. So the FVO is irrevocable, but the P&L is impacted by the fair value changes of the bond after the swap is terminated. Now let us see here. So here the fair value of the interstate swap, this was the fair value. This is the fair value of the bond, resulted in 0. Second year, this minus this resulted in 0. Unfortunately, from the third year, the swap is terminated. So that means there is nothing that is coming from the swap, whereas this bond has to be valued on a fair value basis, resulting in again huge fluctuations in the P&L. So if the Treasury Department sells or liquidates or terminates the interstate swap due to whatever may be the reason, the CFO will again lose his job. The CFO will lose his job because of this huge fluctuation that comes from the bond, from the hedged item, which is the debenture or the bond, right? So FPO is not a remedy, because this remedy is worse than the disease. This remedy is worse than the disease. So this is not an option. So what is the option? The option is to follow what is called as hedge accounting. That is where I'm coming from. So you will have to follow hedge accounting. So if you follow hedge accounting, then what you can do is the fair value, this will go back, the debt security, this debt security will go back to measurement at amortized cost after the discontinuation of this. So which means this will be measured at amortized cost, resulting in very, very minimal fluctuations. I'm not saying there will not be any fluctuations. There will be fluctuations, but these fluctuations will be very, very minimal. Okay. Okay, now if you have understood this one, so we can go to the key part here. Okay, let us go to the next one, which is your expected credit loss. I want to cover this, and I think with this we will complete the session, because this expected credit loss is very, very important. Now I want to cover this at a very, very high level, okay, without compromising the concepts here. If you have any questions so far, can you please send me those, like what you sent last time? Can someone share the screen and show the questions, please? Can we have the questions? Okay. Yeah, wonderful. Okay. What is the question? Wait a minute, I'm not able to see. Can you slightly enlarge it? It's too small for me. Okay. Can you give an example with journal entry? Which example? Which one for journal entry? Okay, for equity shares sold, which are classified as FVOCI, not FVTOs. Okay, FVOCI. Equity shares sold are classified as FVOCI. Okay, fair value of the swap, it is a complex process. It is not coming under the accounting standards mode. It is coming under the valuation standards mode. So we will be trespassing our limit. So we can't do that. And also it is a complex process. Okay, that is beyond the scope of this session. We are only looking at the accounting side. So there will be a team of experts, registered valuers, who will do the computation of the swap value and provide it to us. We will do only accounting part. Okay. So if you are attending registered valuers course, then that will be the subject of discussion, how to value. So I just showed the value in a very crude way, like just to tell you whether it is going to result in a liability or an asset. So depending upon whether you want whatever you receive is more, if what you receive is more, obviously it will be a asset. If what you pay is more, it will be a liability. So I just wanted to show. So these numbers of fair value numbers are all assumed numbers, just some ballpark numbers for you to understand the concept here. Okay, so the example with the journal entry, okay, I don't have, I showed some journal entries. I showed about the treatment. Was that not enough? I showed the journal entries for the various classification of equity, fixed bond for classified as amortized cost, bond classified as FVTPL, bond classified as FVOCI. I think I showed all the three. And I also showed you how the classification, where how it will impact, from when the equity shares which are classified as FVOCI are liquidated. So when they are sold, when the equity shares which are classified as FVOCI are sold, the whatever is already there in the OCI remains there. It is not brought back to the P&L. That's what I told you. Whereas if it is an amortized cost, or if it is a debt security, then it will be, if it is a FVOCI, whatever is there, it will be plowed back to the P&L. That's what I told you. I think any other questions, please? Okay, so there are no further questions. So we will let us quickly. Okay, are you? Okay, show the screen. Okay, now let us see this. Let us see ECL. Okay, ECL. Okay, very important points. No specific method or model is prescribed in the standard for ECL. Okay, it is principle based. All the principles are given in the standard. There is no PhD, no Nobel laureate is required to compute this. You don't have to be a PhD, or you don't need a Nobel Prize. It is a simple model that passes common sense test is good enough. It should be a simple model. It should be consistent. What is very important is that it should be consistent. Why it is to be consistent is because especially the regulators are insisting that it should be consistent. The reason is because if you change the model, it will result in some huge change in the numbers. Okay, sometimes the entity may use this to manipulate the results, right? They may want to increase or decrease or whatever, right? So that is why it has to be consistent. Of course, it doesn't mean that it is something that is cast in stone. Don't get me wrong. It can be calibrated progressively. So what you can do, this normally keeps happening in all validations. The reason is because depending upon the data availability, you will keep changing the model. You will keep not changing the model, you will keep calibrating the model. Okay, so that is allowed. But what is not allowed is to change the model every now and then. So some of the methods that are used are transition matrix method, discounted cash flow method, ECL for project loans is calculated separately, ECL for receivables is also calculated, based on the simplified model. So this is the for you to understand at a very high level. Okay. Now this is very important. Now if you understand the next 3 slides, you have understood the ECL almost in full. Okay. It is the present value of cash shortfalls. ECL in a nutshell is the present value of cash shortfalls. So the cash shortfalls is defined as the contractual cash flows less or reduced by the expected cash flows. So the contractual cash flows minus the expected cash flows will give you the cash shortfalls. Exposed, this is also, it can be rewritten in a language known as this exposure at default multiplied by probability of default multiplied by loss given default multiplied by the discount factor is your ECL. Okay. Now this ECL is a concept that is very new to all of us. Okay. As accountants, all of us, this is new or relatively new, so to say. Okay. But as a banker, this is not new, because in banking parlance, this Basel has this ECL provisions for a long time, for more than 15-20 years. It is already there. So the ECL is not new as a concept. It is new as a concept only for the accountants. Okay. Now let us drill down here. I told ECL is the present value of cash shortfalls. So present value is based on the effective interest rate. We already saw what is the effective interest rate. Cash shortfalls is contractual cash flows less expected cash flows. EIR is EIR as per the standard, Ind AS standard. This can also be written, as I told you, exposure into PD into LGD. Exposure is outstanding amount, which is principal plus interest. PD is the probability of default. You can compute this in multiple ways. There are multiple ways to compute this. LGD is somewhat straightforward. Here, this is 1 minus the recovery rate. What is recovery rate? Recovery rate is the collateral that is provided for the loan as reduced by the haircut divided by the exposure of that particular loan. That is your recovery rate. Okay. Now, so I hope this is clear. So let me reiterate. ECL present value of cash shortfalls. Cash shortfalls is exposure PD LGD. Here the EIR, this is what is discounted. Now the cash shortfalls are discounted based on the EIR. Exposure, outstanding amount principal plus interest. PD, several ways to compute. LGD, 1 minus recovery rate. Recovery rate is collateral minus haircut divided by exposure. Now this is new. What is new here is that this is forward looking. Now this incurred loss is replaced with the expected loss. Now the reason why this was necessary was because incurred loss used to be too little and too late. That is why this came in. Now here okay. So what is in scope? What is out of scope? Okay. So all financial assets, debt securities at amortized cost, even FVOCI, all these are covered. Okay. Loan commitments, which is not measured at FVTPL, lease receivables and contract assets. Okay. What is important here to note is that even trade receivables, this I have explained very clearly. This I have mentioned. Even trade receivables, you have to compute ECL for this. Out of scope, equity investments and loan commitments. Okay. Now this is the essence. If you understand this slide, you have understood 50% of ECL. Now all the assets will normally undergo these. These are the 3 stages that it can undergo. First is stage 1, normal asset. Whenever you buy, this is where the asset is going to be. So for this, you need to provide 12-month ECL. It includes financial instruments that have not had a significant increase in credit risk. So now this is significant increase in credit risk is what is covered here, that is in stage 2. So if it undergoes significant increase in credit risk, then it becomes stage 2. So here stage 1, it has low credit risk at the reporting date. Interest revenue calculated on the gross carrying amount, that is before deduction for the credit allowance. Okay, that is. Now stage 2 is where this is also called as SICR, significant increase in credit risk. So it includes financial instruments that have had a significant increase in credit risk, that do not have objective evidence of impairment. Anybody? You said something. I heard a noise. Okay. So this is then stage 3 is where it is already impaired. Okay, it is already defaulted, is final stage 3. So credit increases, the risk increases to the point it is considered credit impaired. Okay. Okay. Now the other way of looking at this is SICR, which is stage 2, then default is stage 3. SICR, no definition, but the standard contains a rebuttable presumption. If it is 30 days past due, it is called as a significant increase in credit risk. In this case, you have to provide for lifetime default loss. Okay. So default means already it is greater than 90 days. DPD is already greater than 90 days. Same as what we have for your NPA classification as per RBI provisions. Okay, NPA. Now, what are the factors to be considered for ECL? First, we need to do a segmentation. That means you have to group all the assets in such a way that the group contains sub portfolios which share common risk characteristics. That is very important. Second one is consider what is the methodology, DCF or transition metrics, whatever may be the methodology. Arrive at the basis for arriving the PD, probability of default, then find out the LGD for that, then compute the exposure at default, principal outstanding plus interest due, apply the forward-looking macroeconomic factors, then apply the COVID scenarios, which is also known as management overlays, then find out the additional macro scenarios to be treated based on separate outcomes. Now these macro scenarios are case dependent. Okay, so depending upon the current situation, you may have to have additional macro scenarios, then assign appropriate probability weights to get the ECL. So these are the 9 steps that you have to follow invariably. These 9 steps, very, very important 9 steps. Okay, you have to follow all these 9 steps. So these are examples of risk characteristics grouping. Okay, no specific method to address credit risk. These are the various methods of approach. The DCF method or loss rate method, roll rate method, PD method, aging schedule. These are all the ones that are also specifically given in the US GAAP. These are the methods that are specifically given in the US GAAP. Okay. Now, we can also use what is called as a Markov chain model. So you find out how each loan moves from one bucket to the other bucket. Okay, so that is important here. So here, for example, you have different buckets. Okay, so 1 to 30 days, 31 to 60 days, like that. You have different buckets. Find out for each loan how it moves from one bucket to the other bucket over a period of the last several years. Then calculate all the number of observations, convert these observations into a percentage. Now this becomes your PD. So how do you compute PD? One of the methods you compute PD is find out the observations. These are the observations of the loan that transitions from one bucket to the other bucket over the entire life of the loan starting from a specific date, and convert that into percentage to get what is called as a PD. Now this apply this. Okay, now this LGD, I told you, you have to find out the collateral, apply the haircut, then consider the recovery cost also, then find out the recovery rate as the present value divided by exposure. LGD is 1 minus the recovery. So compute this separately. Then the third step is take all the relevant macroeconomic indicators. Okay, so there are several factors, okay, which we macroeconomic indicators like inflation, unemployment rate, interest rates, GDP growth rate, HP house purchase index, or any other reliable thing. All this are factors, but you have to find out whether there is a statistically acceptable correlation, and based on that you select this macroeconomic indicators and then compute the ECM. Okay. Now how to build the scenarios, I have given an example here. So get the loan receivables, get the relevant macroeconomic data for the respective period, then you run a multivariate regression analysis. Okay, this is part of your statistical test. Then you find out whether it passes the R-squared test and p-value. Then you iterate the regression with the other combinations of the dependent and independent variables. Get the intercept and the slope of the analysis to find out the projected value of receivables. So here I have given an example. So this is the macro data. Now what macro data we are considering? GDP. We are considering inflation. We are considering risk-free rate. So I have taken right from June, this is March 2015. This is March 15. Okay, right from 2015 March onwards till about March 21. All the quarters are considered. Take the percentage of the receivables, the loans, whatever. Okay, for the same periods, take the percentage. Then run a correlation. This is what is called as a multivariate regression statistics. Run this multivariate regression statistics, and you will see that this one, whatever is in green, the test is passed. Here also this R-squared test is passed. This R-squared value is okay. Then all these p values are okay. It is passed. Based on this, you get what is called as an intercept, and these are the slopes of these two variables. Okay, so these two variables, we get the slope and intercept. Apply this for the respective macroeconomic variables, and you get so apply the slope and intercept, and based on this, whatever you see in the yellow, these are the projected 2 additional scenarios based on the projected rates. These are the projected or the forward-looking macro data that we apply, and this is what you get. Okay, now that translates into, so we are not using this risk-free rate because this risk-free rate is not passing the test. Okay, only these two rates are passing the test. Based on that, we have arrived at this is the bump up and bump down scenario that we are obtaining based on running the macroeconomic, running the multivariate regression analysis. Okay. Then assign the probability here. So various outcomes, you assign the probabilities. Okay, various scenarios, assign the probabilities. Now there are two things. One is the probability weighted. This is what is relevant. Even though the most likely outcome is 40%. Okay, this 2000 is the most likely outcome, but this is not considered. This is considered as per US GAAP, whereas as per IFRS or as per Ind AS, what is relevant is the probability weighted, which is 2362. Okay. So now this is how the various the weighted average is actually worked out. Okay. So you have the regular model scenarios, apply the probability for probabilities for each scenario, and find out the probability weighted ECL and find out the total. This is how this arrived at. Okay. So this is how this ECL is computed. This is I'm given this at a very high level or a very broad level, because we can go only up to this extent because it's already 7 o'clock now. So please let me take 5 minutes to answer your questions, and of course I'm going to share the detailed PowerPoint with you, which has certain other information as well for you to study on. And also I have the my email ID as well as my telephone. So please feel free to talk to me for any doubts, clarifications, whatever you want. Don't hesitate to do that. Now let us take on the questions. Sir, can you please share the questions, if any?
इसमें मैं अनम्यूट नहीं कर पा रहा.
Sorry. Hello sir.
Vaji,
सर बोलिए
are
सर.
there any questions?
हाँ सर, दे रहा हूँ सर.
हाँ जी.
Are there any prescribed guidelines to determine significant increase in credit risk? Okay. So okay, now there is no guideline as such, but the point is it is if the credit rating has fallen by 2 notches, then you can take it that there is a significant increase in credit risk. That is one. The second one is there is also what is called as the rebuttable presumption that is given in the standard, which says that if the DPD, that is the days past due, exceeds 30 days, then it means that there is a significant increase in credit risk. Okay. So and you can say, apart from this, if you say even if it is not even 30 days, it is only 20 days, you may still say that there is a significant increase in credit risk based on certain various other parameters which the management or the auditor may observe. Okay. So whether the customers from Ukraine and Russia be considered under the same group for ECL working with the rationale of similar macroeconomic conditions. No, I mean this question, I don't know to what extent, because it's highly if are you based in Ukraine or are you based in Russia? No, you are based in India. So what I understand is you are based in India, and you have customers in Ukraine, you have customers in Russia. Okay. So it depends upon what is the nature of industry, what is the nature, what to what extent it is affected. You have to take a judgmental call. See, these are not something that is mentioned in the standard as such, but of course, if you look at the macroeconomic factors of those countries, obviously it would have taken a beating, which will jolly well reflect in your analysis. Okay. And you share please the details for the session starting 17. Okay, I will do that. Let me multivariate regression. You explained at a high level. Can you recommend book? No, you just see today. This is available in plenty. Knowledge is available in plenty. Just Google multivariate regression in YouTube. Okay, and you will see a video which will tell you how to do this multivariate regression step by step. There will probably be 50 or 60 videos on this topic. Okay, so you don't even have to have a book. Just go through the videos in YouTube. I mean, that's what I do if I want to learn a new subject. Okay, now let me share the link here. Okay, which is provided by ICAI. What I will do is, where can I paste it? Can I paste it in the Vaibhav, can I send it by WhatsApp to you so that you can cut and paste it here?
Sorry, sir.
No, can I send it by WhatsApp to you? That link, because you know that link I can't. It'll be difficult. I have your this thing. No, can I do that? Yeah, I have sent it by WhatsApp to you. I don't know whether you got it. A link for that. Otherwise, I don't know where to paste it. You know, of course, I can do one thing. I can. Okay, what I will do is, are you seeing my screen?
Yes, sir, it's visible.
Okay, this is the one. So, yeah. What happened? Sorry, you got it, no? So this is the cdn resource.cdn.ici.org/69673 ASB 160322.pdf.
Sir, if you can post it in the chat box, it will be helpful for all the.
That's what I was thinking. How to do that?
The WRC team can also help you.
I don't know. Wait a minute. Chat. Oh, okay. Chat box. Okay, chat is not. No, it's not active. No, I'm not able to. Oh, wait a minute. Oh, okay. I got it. Okay, I have done that.
Okay.
Right? You got it? Organizers. I will do it for all.
Yes, sir.
I don't know how to do it. Maybe you can put it for all. You can just copy it and paste it for all. You got it?
Yes, sir.
So if you have any further questions, please feel free to write to me. I will share all the PPTs to WRC after the session. Okay, by tomorrow morning, I will probably share this with the WRC, and it will be put in the. So thanks a lot for your participation. I think good participation. I hope you are benefited by this. And thanks WRC for giving an opportunity to make this presentation here.
Thank you so much, sir. WRC team, should I proceed with vote of thanks?
Yes, sir. Sir, question nahi agree, sir.
Okay. There are no further questions, right?
Yes.
Okay, no problem. First of all, many thanks, sir, for explaining these complex concepts in a simple language. And I hope the participants would have enjoyed this virtual Ind AS refresher course, right, starting from 26th of April. And it is because of all you speakers, this course becomes quite interesting and enlightening. And also all the fellow participants can apply those concepts which have been explained in all these days So I have attended the webinar, and right from the backdrop to Ind AS 32, the financial assets, financial liabilities, equity instruments versus liabilities, and all other concepts like Ind AS 109, wherein you have explained the measurement concepts through amortized cost, PNL, and OCI. And of course, sir, we are enriched by your knowledge today, and would like you to be there for future programs as well. Thank you again, sir.
Thank you. Thanks a lot. Thank you, participants. Okay.
Thank you so much.